Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil trading this morning just up a few cents above those $74 a barrel. It's that magic number. Is the 74 the new sort of crossroads after the bumper Fed rate cut yesterday? Markets digesting it perhaps still, but not a major reaction. At first, it was a downward move, but now it has continued what has been an upward climb ever since Russell and all his mates in Singapore tried desperately to talk the market down last week, but didn't succeed for very long. No, only joking. I'll kick off with Russell Robertson, Chief Commercial Officer of the Gulf Mercantile Exchange. I'd first welcome you, Russell, to that very exclusive club of places called Gulf something.
Thank you, Sean.
You are now the Gulf Mercantile Exchange, which in itself tells its own story when it was previously Dubai Mercantile Exchange. But Russell, your opening thoughts on my question to you as a kickoff this morning. What number are we more likely to hit first? $80 on Brent or $70 on Brent? And now that we have the Fed cut behind us.
Good question, and good morning, and thank you for allowing me into the club. It's very exclusive. So I guess as an exchange guy, I'm not really here to predict prices, but I guess from a personal perspective, to me, on the Middle East price, so we hit just above $70 on the market price on the 10th of September. We didn't close below there. We slightly sneaked below it in the end of day settlement, but that's not quite a true reflection of Middle East market. So to me, I suggest that, or I think with my trader's hat on, that we haven't quite broken out of this long-term range that we've been sitting in. So it feels a little bit like a bounce to me, but we have had some quite bearish news coming, and it hasn't seemed to have impacted the market. So I would say it still feels a little bit heavy just from personal perspectives. And I think really now it's what's left is OPEC. So I think it's difficult for them to do something, but that really is going to be, I know we keep talking about what next, but this feels like the next thing is OPEC. And of course the US elections, but OPEC to me seems like a
minor event. Let's welcome to the table, I think for the first time, Dr. Patricio Valdivieso, Vice President, Oil Markets and Global Lead for Crude Trading Analysis at Rystad Energy. Dr. Patricio, your thoughts on the same question? I mean, ultimately, it seemed the market was waiting for many things in recent times, but ultimately, the Fed rate cut, it sort of had got everybody's distraction, and it was somewhat of a fog. But now that fog is cleared, and my God, has it cleared? The Fed has given us a bumper 50 basis points. Give us your analysis on that decision they've made and how it will play out in the oil markets.
Hi, Sean. Thanks for having me. So yes, I think the decision from the Fed has a lot more to do with the U.S. economy and their financial struggles, and the fact that they need
the U.S. economy is the world's largest oil consumer.
Yes.
So does the Fed see a cliff edge that we don't see? Full employment?
Yeah, well, definitely employment figures have been a bit weaker lately, but I think fundamentals, especially U.S. shale growth, has been recently revised down by us at least to 280,000 barrels per day, which is quite a significant reduction compared to last year and even estimates at the beginning of the year. I think supply side fundamentals are relatively strong, but we still do see that the overall crude global balance is short, right? For the fourth quarter of the year, it's quite short. So how I see the reaction in prices is that there's a bit of a disconnection between fundamentals from the supply side. I think it's a much more demand-driven problem.
Let's welcome Bora Berryman, Managing Partner at Hormuz Trades Partnership. Bora, welcome your thoughts again, just picking up on the Fed rate cut. More than expected, generally being seen as the Fed front-loading this turn from being a tightening universe to being an easing one. Your thoughts, A, on their decision, and B, how it's likely to play out going forward?
Yeah, I mean, the decision was expected because there had been
so much, I would say, kind of public and political call for this type of move. And that's despite the fact that the economy is strong and unemployment is by historical standards low, but there has been, I would say, a geopolitical creaking in the background. For example, significant economies, as well as significant players like Brazil and non-euro European economies like Czech Republic and Hungary. They've been decreasing rates since the end of 2023. And the UK started last month. The ECB started in the summer. China has never even raised rates. Sorry, decreased rates since COVID. So, the US not having had a rate cut since March 2020, you could say is an indication that they were in a position of strength and they were the last to break in a certain.
Let me ask you, Bora, as a banker, I was trying to remember and I couldn't have time to research the history too deeply, but I certainly can't remember the last time the Fed cut rates by any amount, especially at 50 basis points, when you had full employment and inflation was still closer to 3% than 2% target. I mean, how does one interpret this? This is an unprecedented move, no matter which way you cut it, that the Fed has taken here.
Yeah, I have a couple points on that. We talk about the Fed, we talk about the ECB. Recently, I've been focusing on the Bank of International Settlements. That's the central bank of the central banks. And they have very interesting analyses monthly, a lot of research and very useful podcasts. And they've recently said the market movements over the past 2 weeks have been hypersensitive to macroeconomic data impulses. And this is setting off the volatile changes in price direction. So again, to your question, what's the problem when Europe is growing and the US economy is humming along at more than 2% growth? And I think that that hypersensitivity is a symptom of the fact that this 2% growth is standing on the shoulders of a federal government deficit that's 7.3% of the economy, of the US economy. And that scale of borrowing has never occurred except for the 2 years after COVID, the 3 years after the global financial crisis, and before that, it was 1945. So basically, in this recent history, we're living unprecedented borrowing conditions that are akin to managing an economy as it would be during a financial collapse, an epidemic, or a world war. So it's not sustainable, but people are making money because, as we know, in war times and crises, you can make money if your business is aligned to government priorities, and that's where the money is going.
Russell, I wanted to get your thoughts on the net short position. When all of you guys were gathered last week in Singapore, we saw for the first time the net shorts in the oil market in terms of the financial investors, the funds into the oil markets. Your interpretation of that, what's its bearing for the markets and the outlook?
Sure. So I've actually been on the road for the last almost month now. So I've been in Taiwan and Beijing and Shanghai, APEC last week, and I'm in Mumbai today and GIFT early this week. So have been lucky enough to get opinions from many different people. And it feels to me like a lot of these shorts that came in were basically very much to what we were just hearing, very sensitivity to that the market's become very sensitivity to macro and geopolitical events that are happening. And derivative markets particularly are giving people much more direct access to be able to react to those things. So the shorts in the oil market were very related to the sudden focus towards the Chinese demand and the impact on the crack spreads and things like that, which were heavy, but we have not seen that range break. So to me, technically speaking, we're still in the range, the 70 to 90 or 70 to 95, 85 being the clever number, or 82. So yes, those positions are being taken, but you will find that those positions are changing much more quickly in current times. And I also take the point we were just listening to. To me, historical correlations are changing. So long dollars, short oil, or interest rates going up means higher dollars, and gold impacts it. These things are changing, and the interactions between global oil demand and the economy, to me, also is changing. So we need to look much more at things like refining runs and capacity changes, and that leads to locational and regional differences too. So it's become quite complex. And I don't think the market has yet quite worked out how these things are happening. And a 50 basis point hike yesterday and the impact that's had is very limited, really, considering if you look at the movements in oil in the last 6 months, we've had days where you can quite happily see a $4, $5, $6 move over 3 or 4 days. We haven't really moved much, really. I mean, the big headline this morning was Brent down 36 cents. I mean, that's not really a lot. So to me,
somebody spilling their coffee.
Yeah, pretty much. Yeah, I agree. So to me, I don't feel like anything changed, really, not yet. It's more about supply and demand.
Well, on that, Dr. Patricio, where's Rystad Energy at the moment on its outlook for supply and demand? I was watching your global seminar with your CEO, I think it was 2 weeks ago, and you were forecasting or sort of presenting that the global demand growth in 2024 was sort of aggregating around 1 million barrels a day. Where is that looking like? How does it load up for the rest of the year, if that's the average for the year?
Yes, so indeed the consensus, I think, amongst different agencies is around 1 million barrel per day growth for 2024. Obviously, OPEC was a bit of an outlier there. They were forecasting 2.2 for the largest part of the year. They just revised their forecast a month ago. But overall,
barely by much. They still have it above 2 million barrels a day.
Indeed. And we didn't expect much of an adjustment from OPEC. And I think that signals to us that the weakness is real, right? That there is concerns even from OPEC. Now, we are relying in the fourth quarter, and we're relying on China's, particularly where we're relying on capacity-driven runs, right? That needs to be delivered. So there's a few ramp-ups of capacity from Yulong in Shandong and Sinopec in Ningbo. We do expect capacity to support demand, right? But this is not demand-driven capacity. So this is capacity-driven runs that should support demand from China. If that doesn't deliver quickly, then I think the fears of big part of the market could realize. So generally speaking, I do foresee this as a demand problem. As I mentioned earlier, global supply is actually contracting for the year. So we're expecting a contraction of around 200,000 barrels per day for this year, right? So this is the first time that's happened since COVID.
You're saying that global demand growth there will be no growth. There'll actually be a contraction?
Global supply.
Supply.
Yeah. Global supply growth is expected to be negative for the first time since COVID, right? So
where does that leave the Americas? I mean, we mentioned earlier U.S. production, not so much, but where about Guyana and Venezuela, obviously now with the new problems on the election, Colombia, Brazil, yeah. Where are all the Americas?
Well, the Americas is still quite strong, but there's been a surprise on the downside for Brazil, for example. Brazil was supposed to bring a big part of the growth for the year, and the first half for Brazil has been very, very harsh. There's been a few issues with maintenance and plant maintenance and infrastructure constraints for many projects in Brazil. So growth has not been delivered from Brazil, and now we've penciled that down to maybe 50,000 barrels per day growth. Guyana is still relatively moderated growth, and Venezuela, it's quite constrained with the sanctions from the US, right? They now rely on special licenses for production. We're still getting some growth for Venezuela, but it's not substantial, right? So really, Brazil was the wild card here. Argentina might surprise to the upside, but again, it's marginal volumes. So that the bigger player here, the US, obviously, is the one that it's adjusting down their growth. So we do know that Shale 4.0 it's a lot less elastic to changes in prices. We do rely on guidance from majors, and I don't see a meaningful surprise to the upside from US growth. So generally speaking, if OPEC continues to extend these voluntary cuts, which I do believe it's very likely to happen for the first quarter of 2025 even, then we should keep the market relatively backward dated, and we should still see a deficit in the overall global crude balances. Now, again, very importantly, the deficit in the global crude balances doesn't seem to be having a meaningful impact in how price is reacting. I agree with Russell that we're ranging now, that volatility has changed, and the relationship between the fundamentals and geopolitical premium has changed as well. I don't think the geopolitical premium has the same impact it might have had a year or two ago.
It's certainly difficult for to see what exactly is the North Star for any market other than what you mentioned, Bora, which is the huge amount of liquidity pumped in by the federal government in the US in particular in recent years. But what does a lower price of money mean, do you think? I mean, it is a big move, 50 basis points, which I suppose signal that they're willing to do similar sizes on the downslope that they did on the upslope. So this might be the only 50 basis point move. Your thoughts, Bora, what does cheaper money mean for the oil markets?
Well, again, I felt that they gave surprisingly coherent and medium-term guidance that, previously cost of borrowing was around 5.4%. They brought it down 50 basis points yesterday. They indicated they would do 50 basis points more by the end of the year. So that's 1% to 4.4%. And another 100 basis points next year. So at least we get down to 3.4%. And they said they might do another 50 basis points in 2026. Of course, I would discount any of that because they weren't following their guidance for this year. But nevertheless, they're telling us, 2% cheaper borrowing by the end of 2025, subject to more or less inflation continuing to slope toward 2%. But a big part of that was the energy price decline of recent months, because especially in the UK, I know if you take out energy prices, inflation is running around 5% for the services sector. But coming back to your point, what does it mean for oil prices? I'm not sure very much.
For oil industry, ultimately, cheaper money is going to entice more borrowings for production. Is it going to create more fluid? We saw last time that money cycled downward in value. It was being spent all over the place like confetti.
Yes, I think in places in emerging markets, it will go to create more oil and gas demand, but I'm not sure that's true in places like the US and Europe. And furthermore, then you have cheaper money in the hands of hedge funds that can short oil and have a lower cost of borrowing for their margin calls when they get it wrong, where they could keep, extending their out of the money positions with less risk, you could say. So it goes both ways. I don't fundamentally feel that there is much link between the cost of the dollar as set by the Fed and oil price. I think sentiment drives oil, and they're completely different matters.
Let's go to the survey question, which is sort of tackling this general theme we've been discussing this morning regarding with the bumper Fed rate cut now behind us, at least the first one, and as Boris said there might be another one just around the corner. What price is Brent crude oil more likely to hit first? $70 or $80? The next zero for the Brent crude oil price, will it be 70 back down to 70? We saw it tip into actually 60 something last week. Tuesday last week during APEC week, it closed below 70 for one day. But ultimately, what is it likely to hit first, 70 or 80? Russell, I'm keen to get your insights. You mentioned there that you had been in China the last few weeks traveling, and in the APEC sort of chattering classes, China weakness was a dominating subject. I wasn't there myself, but my understanding from everybody I've talked to that was there and all the reporting, everybody was sort of bearish over bearish in some ways, perhaps on China. But having been there recently yourself, would you concur that level of sort of economic concern for China in APEC last week was warranted and continues to warrant a fragility in the oil markets?
Sure. So I would say at a high level, probably it is warranted. But the language when you're in country does tend to be quite limited. So you have to interpret it how you want to interpret it. So generally, when you speak to the national oil companies on the mainland, their outlook for next year is one of flat to growth. So that they also negate that by saying we will be happy to reach those targets. The main message I get is internationalization, opening of the economy. So you can interpret that how you like. Why are they doing that now? But we had some quite interesting meetings with regulators and these types of entities, and it's very much about how do we globalize and create further liquidity in all different senses from top down into the region.
In that point, I mean, that China is obviously going through a weaker economic cycle at the moment, in the sense that its consumption of oil, its consumption of energy, although it does seem to be still consuming very large amounts of coal and increasing every day. But ultimately, the electrification of the Chinese economy and the drive towards services is not so much about a weakness in the Chinese economy, but it's an economy that is changing from being ultimately a manufacturing cheap Barbie dolls to one that is looking to go up the value chain. Is that a fair assessment to what your sense of on the ground in China is?
Are you worried about the price of Barbie dolls going up, Sean?
Yes, that is my primary concern.
So yeah, I totally agree. The EV market is definitely having an impact on crude, and the outlook into how some of these state-owned companies are looking at their business going forward. So there's definitely an evolution taking place at the moment. It's going to be slow, but it's happening, and we see that in the crack spreads and diesel demand. And on a personal note, when you're driving around in Shanghai and Beijing, you see a lot of electric vehicles. I mean, a lot, and it's some that I'd never heard of. I even saw a Lotus SUV electrical vehicle. I've never seen one before, but the BYD vehicle, Beyond Your Dreams, is very popular. So on the mainland, it clearly is changing. We obviously don't see that so much in Dubai, but that's having an impact, and there is still. So the other thing to think about is they're also modernizing a lot of their technology. So especially if you look in the refining capacity, so the concept of things like Yulong refinery, which is basically taken 10 smaller and made one mega, that's not necessarily a sign that they are reducing their desire to refine, but they're just becoming more efficient. So it's an interesting space, and I think, to not trying to avoid your question, but it's still evolving, and we need to keep a close eye on how that plays through.
On that, Dr. Patricio, I mean, from looking at the China evolution, its change, last week also in APEC, we had the CEO of Vitol, the world's largest independent trading company, calling that peak gasoline demand in China could be reached this year or next year. This is a very significant change moment in the oil markets as a whole, when the source of incremental demand growth for 30 years is essentially ending. Is the market, our suppliers, producers, is OPEC Plus grasp this fact, do you think? Does it seem like that realization is anchored in or is anchoring in?
I wouldn't go as far as saying that demand growth is ending from the China's perspective, but certainly it's decelerating.
I'm just telling you what the world's largest oil trader said last week, that peak gasoline demand is arrived or is about to arrive like next week, not in 5 years.
We certainly see weak diesel and gasoline demand for 2024 in China. Overall demand growth is mainly driven by naphtha supply push, and that it's even being revised right now. About 8 million tons were scheduled to come online this year and have been pushed back to 2025. So definitely there are some concerns regarding where is demand support going to come from in terms of China. In fact, when we look at the real-time figures, real-time demand figures for China, we don't really see a good performance in terms of our index versus pre-pandemic levels, right? So generally speaking, if you look at regions, Asia as a whole, it's underperforming in terms of demand this year. Now, we do have concerns regarding, the effectiveness of stimulus. We do have concerns regarding consumer demand recovering before 2025. The property sector challenges, right? Population decline, the US-China trade tension. So there's a lot to worry about, but I do foresee that, for example, the
other thing to worry about ultimately is supply, too much of it, right? I mean, my sort of query, and I don't necessarily have an answer for it, but I do think we may be getting close to a tipping point moment if you accept some form of peak oil demand in China, maybe not tomorrow, but in the window of peak oil demand. And the OPEC plus strategy, OPEC plus is still to cut, and then allow higher cost producers in the Americas to step into that. This may be the moment that actually that game could be over, that the OPEC plus, the lower cost producers, are once and for all going to have to actually just claim their space and push out the higher costs. I mean, I don't know. This is not a small moment. China peaking, the source of peak oil demand, it has to trigger some different things. Your thoughts on that? From we've seen twice in the last decade, OPEC choose a kind of an oil price war to calm down shale mainly, but choosing that option again.
There's a bit of an alignment now between OPEC and US shale, I feel. The US shale has changed fundamentally, right? So they are much more concerned about free cash flow, and reinvestment rates are going down, right? So they're much more concerned about getting returns for their shareholders. And I think the alignment of objectives between OPEC and the US shale, it's actually materializing. I agree with you. I agree that OPEC is facing a rough decision. It's been like a year and a half or two of really tough cuts for Saudi. They are taking the toll and they are losing the share, right? So they will at some point have to make this hard choice between supporting prices and regaining the market share. And I think you are right in that that time it's not far. I'm not sure we are facing it in the next quarter or two, but for sure in the next 5 years that will happen. And that's
if we're going into a flat to marginally demand growth of under 1 million barrels a day, that doesn't leave a lot of room for everybody. Let's wrap up, Bora. You get the last word.
May I add a very quick comment on this, because I think that's something that's come up a lot recently. Something we need to think about, and I think it relates to what we're all talking about. I'll be quick. We need to look at refining economies and how it's moving, right? Europe is closing, the GCC, the global south is opening, right? So yes, so demand is maybe reducing, but that's going to be a huge shift in flows. So sorry to interrupt. I think it's a really important thing to think about.
Bora, last word to you. Price is Brent crude oil more likely to hit 70 or 80? This room is sort of split down the middle. We'll see where it goes on when we post that same question on social media. But I didn't want to end our call today without acknowledging that there has been a fairly significant escalation of regional tensions in the Middle East, in around Lebanon, Israel, and the developments there in recent days. Again, it doesn't seem to be trickling into the oil markets. That geopolitical risk premium remains subdued. Your thoughts on that continuing, that this market has so much oil supply that it's not perturbed by these developments, Bora? Your thoughts in closing out?
Yeah, I think while we were just chatting about market share struggle between OPEC and non-OPEC, what came to mind was the market share struggle between Chinese electric vehicles and the German auto industry. And we see, a lot of security considerations being raised to justify trade barriers and tariffs to block Chinese penetration into these markets. So I think that's part of the mix here. The fundamental profile and the innate nature of the driving season is changing toward an electrified driving season, and I think that's where the market share struggle will be between, I think, China, which is a little bit ahead of the curve compared to Europe and America in these areas, and the Europeans trying to catch up, and OPEC is the spectator, just waiting to see how this pans out. But again, the geopolitical uncertainty will persist. I had never really thought about these security concerns around the Internet of Things and why they're so concerned about Chinese vehicles and can they be hacked, until now I see that they can blow up your pager. So it's coming to hit home now.
Yeah, there's certainly new things to think about there. Go back to typewriters and pigeons, it seems, although you can shoot a pigeon out of the sky, so maybe I don't. But yeah, these are new and strange tactics. Brent crude oil trading up as we wrap up our half hour together, solidly, a few cents so solidly, but above 74 and climbing. I think with the Fed rate decision behind us, there's a good chance that this market shifts from being a glass half empty sentiment to a glass half full. And all of the reasons why you would think of it half full, low inventories, tight supply, geopolitical, and of course now a bumper Fed rate. You add that into the glass half full cup, and I think you've got some momentum potentially. Leave it there. All the best. Thank you so much, as always. Great to have Dr. Patricio of the Rystad Energy joining us for the first time. Bora Barrowman back at the table. Russell Robertson now with the Gulf Club. GME, welcome and congrats. And we look forward to seeing the great things you do, Russell, with the Gulf Mercantile Exchange, which of course has the partnership now with Tadawul in Saudi Arabia. All the best, guys. Have a great week. Cheers.
Bye-bye.
Thank you. Cheers.